Hello and welcome again. In the last lesson, if you remember, we looked at the topics which we will study and which were part of our syllabus. In this lesson, as I spoke to you earlier in the last lesson, that we will see income tax. Now before we move to income tax, make yourself comfortable with the tax system, tax itself and tax system specifically in the UK. If you're comfortable with them topics, that's fine. We can proceed from here. But as far as if you are not comfortable with them lectures, say you don't know what tax is, what taxation in the UK is, who is monitoring taxation in the UK, say for example if you are exempt from F6 or if you are exempt from earlier ACCA exams, then please go to our website section F6. Now if you go to F6 section, make yourself comfortable with them topics, and if you're comfortable with them topics, then you can come here and we can proceed from here. You could also have forgotten what you have studied at F6. Then in that case as well, you should have to you should go to F6 and make yourself comfortable with them lectures. If you are comfortable, then we can continue from here. I assume that you are comfortable with them lectures, and we can proceed here with the income tax, which is our first topic. Now again, I would insist to before we start our lecture, that please download lecture notes which are available on our website, and please put the lecture notes in front of you when we solve this exam. Now when I am writing down here, always make sure that you are writing down what I am writing down here, even if you have them in lecture notes. Say for example, if I am writing down something here which you already see on lecture notes, then you may think that there is no need to write it down because we have already got in the form of lecture notes. But please make sure that you again write it down with your own hands on your notebook, so that you make yourself comfortable with them, and you should not forget that. Having said that, let's move to taxation. Now I hope that at this level you know what accounting date is. Accounting date simply is when the company is making account to. Say for example, company may choose to make its account to 31st March, or company may choose to make its account to 31st December, or whichever year they prefer. So whichever date they may choose, they can choose, because there is no obligation as per law as far as accounting date is concerned. However, a company which is making account to say 31st March or 31st December, although there is no requirement from law perspective as far as accounting date is concerned, but if you come to taxation date, there is only one specific date which we have to stick ourselves. So that is, what is that? In the UK, tax year deals with the tax year starts on 6th of April. 6th of April to 5th of April. Obviously next year. So tax year starts from 6th of April and it ends on 5th of April next year. So for example, if we talk about our own selves, then tax year starts on 2015, 6th April 2015, and it ends on 6th of April 2016. That is our tax year. Our tax year Finance Act FA 2015. So our Finance Act is 2015. That's why these are our relevant dates, right? Now if you know what does it mean, and you might think that why they have chosen this strange date. To be honest, I don't even know that why they have chosen 6th of April or 5th of April, but this is the rule, so we have to stick to that. So tax year starts on 6th of April and it ends on 5th of April each year. So that's how the taxation itself works. Say for example, if I am earning some money, I will have to account for from 6th of April to next 5th of April. That's how I will pay tax. That is the tax year, right? Having said that, let's move to our income tax Proforma. Now, as I explained in the earlier lesson as well, that income could be earned from many different sources, right? So it could be earned from dividends, which we earn from having shares in a company. We could have some money in the bank and we are earning some interest, so that is also income. If I am working for someone, I am earning some salary. That is also one part of income. If I have a business and I am earning some money out of business, that is also one part of one type of income. Say for example, if I am retired, I am getting paid in shape of pension then that is part, and that is also some sort of income. So whatever sources we are getting money from, we have to list all of them down under the income tax pro forma. Now that is called income tax pro forma. Now income tax pro forma is available to you in front of you on your notes. If you move to page 2, income tax pro forma is there. Right, now I'm writing down exactly that same thing here, so that you should also write it down with me, right? Now when we see the income tax pro forma, as per tax is concerned, income is divided into 3 sections when we talk about the income tax pro forma. The 3 sections are, one is non-savings income, other one is savings income, and the last one is called dividends income, right? So you can see it on your own lectures as well, that as far as tax authorities are concerned, they say that please divide income into 3 sections: non-savings, savings, and dividends, right? Now if you remember, I told you earlier that income could be earned from many different sources. Now here in the description, this body is called description. Now if I just put a line here to make it separate from that section, now this space is called description. I will list down all the income sources which we can earn. So say for example, if I am earning some money from dividends, right? So if I'm earning some money from dividends, that is also part of income. So these are bits and pieces and sources which we can earn income from, and these are also called components, income tax components, right? So first source of income, I write it down here as dividends. Now if you see here 3 sections: non-savings, savings, and dividends. What do you think? Where shall I put dividends underneath? Under dividends, savings, or non-savings? Obviously dividends, because these are dividends, so we will put it under dividends, right? So dividends will come here, right? So dividends will come into dividends. Now before I move forward, let me also tell you that dividends, when we receive the dividends are received net. So what does net mean? Is that tax has already been deducted from the dividends, which is 10%. So tax deducted at source is 10% from the dividends. So when we receive the dividends, we also receive net. So when we receive something net, we have to gross it up, right? So how can we gross it up? Say for example, 10% tax has been deducted from the dividends, so we have to gross it up. How can we do it? We can multiply it by 100 and divide it by 90, obviously, because 10% tax has been deducted, right? That's how the dividends work, and dividends will go on into the dividends, right? So that's always we do like this. Okay, so shall we move to next component then? Next component is called interest income. Now say for example, if I had some extra money which I was putting on one side each and every month when I am being paid in shape of salary. Say for example, if I'm getting £2,000 salary and I am putting £100 on one side as a savings. So I am putting one side on £100 on one side just to save that money. All right, but what can I do else to save the money? I can put that savings into the bank to earn some interest. So instead of keeping that £100 at home, why not I shall put it in the bank and earn some interest, so that after 1 year this amount which I had at home will be £1,200, assuming £100 a month will be £1,200 a year. So if I put that amount into the bank, then they may pay us interest, right? Then if as compared to the amount which I kept at home, it will be higher than that, because it would have earned some interest as well. So it is better idea, it is always better idea from business perspective. You should put extra money into the bank so that you can earn some interest. So you will always put saving into the bank so that you can earn some interest, right? So saving is always go into the bank to earn some interest. So the savings which I put into the bank has earned some interest income. So interest income has come through savings, so it will go into the savings, because these were savings that I put into the bank. So that's why interest income will go that. Now these are only two components of income: dividends income and interest income. These are only two components which go into the different sections of the income. As I said, there are three sections: non-savings, savings, and dividends. Now dividends will always go into the dividends, and interest income will always go into the savings, because that's how I have earned interest, by putting savings into the bank account. That's why interest income is going into the savings. Right? Now interest income is always being paid, always paid as net, right? Just like dividends. But the tax paid on the interest is not 10%, it is 20%. So we'll have to gross it up as well. In the same way we did dividends, but the tax paid on dividends was 10%, tax paid on interest is 20%. So how can we gross it up? Yeah, you were right. Multiplied by 100 over 80. So that's how we can gross it up. And we'll write the grossed amount in these sections, always. Alright? Although we will receive the dividends and interest we'll receive it as net, but we will always gross it up, and we will put here as gross. Okay? That's how we do it. Now, as far as interest is concerned, interest may have been received gross. You will have to see in the questions. Some of the interest may have been received gross. If it is received gross, then no need to do this grossing up thingy. You can write this exact amount here and no need to gross it up. And if it is received net, then you will always have to do this bit in order to get the grossed amount here. Right? Now, apart from these two sources of income, please check your notes on page 2. There are different other sources of income as well. Now, if you want me to write it down here, actually I should write it down here as well. Now, other sources of income, I can earn employment income. Right? Now, employment income will go into non-savings. Now, as I said, dividends go into the dividends, and interest income will go into the savings. The rest of the income will go into the non-savings, whether it is employment income, property income, trading income, or whichever, it will always go into the non-savings. Right? Now, employment income, as I listed, employment income is simply income which I earn from my employment. Say I am working for this company, AccountancyTube, and I earn some money. Now I'll have to write it down as employment income. Now this Proforma is a Proforma of an individual. It is not of a company. So that's why if I am an individual, I can earn money from many different sources. So say for example, if I am making this my own Proforma, so I can earn some money from dividends, I can earn some money from interest, and as well, just like that, I can earn some income from employment as well. Right? Now there could also be a trading income. Say for example, if I have a business and I am earning some money from the business, that is a trading income, and it will always go into the non-savings, as I said, and just two incomes will go into the different columns. The rest of the stuff will go into the non-savings. Alright? Another portion of income, another source which I can earn income from is called property income. The property income is income which, say for example, if I have an extra house and I let it out to someone else, then I am being paid in shape of rent. That is called a property income. I will have to pay tax on that as well, right? And it will go into the non-savings income, right? Only interest will go into the savings and dividends will go into the dividends. Everything else will go into the non-savings. All right? Now, I may have pension as well. It will also go into the non-savings. Now, what is pension? You might know at this level what is pension. Pension is simply money which is being paid by the employee itself to a separate body, so that when he retires, he is paid back that specific amount with some interest or some profit. Right? Say, for example, if I am working for this company and I am paying a little amount, say for example £50 or £30 a month towards my pension, so when I get retired, so that I can earn that specific amount, right? So that is called pension income. Now, as far as the government is concerned, now government is very, very happy if you are contributing something towards pension, because government feels that if you are contributing from your own pocket, then you will not rely on the government benefits when you retire. So that's why government encourage if you put some money into the pensions. But we will see later what are the benefits if government is giving you if you put some money into the pensions, because government likes it. Now, if government likes it, then definitely government is going to give you some benefit if you put some money into the pensions, right? Now, these are the sources of income as I listed: trading income, dividends, interest, employment income, property income, pension income, and there could also be income from different trusts. So there are two types of trusts: discretionary trust, you may see it on your notes, and other is called interest in possession trust. I will just write it down as interest IP. So interest in possession trust, there are two types of trusts which you can earn the money from. Now, as far as discretionary trust is concerned, this income will go into non-savings income, right? And as far as interest in possession trust is concerned, now it depends that how the money is being paid to you. Now, interest in possession trust may have been paid out of non-savings income, may have been paid out of savings income or dividends income. It depends, right? Now, if it is being paid out of non-savings income, it will always go into the non-savings. And if it is being paid out of savings income, it will always go into the savings. And likewise, if it is being paid out of dividends, then it will go into the dividends, right? So it will tell you into the question, it will always tell you in the question that income from interest in possession trust paid out of savings income or paid out of dividends income, right? Now, as far as discretionary trust is concerned, it is always paid net. So it is always paid net, but how much tax has been paid on it? 45% of the tax is paid on it. So we will always gross it up as 100 by 55. 100 divided by 55. Right? And if you talk about the interest in possession trust is concerned, it is always, this as well is always paid net. So how much tax is paid on this one? 20%. So we will gross it up 100 by 80. Right? Now you might start to think, as far as interest in possession trust is concerned, you might start to think that it is 20% tax has been paid on this one, and we have grossed this one like this. What if this is being paid out of dividends income? Do we still need to gross it up 100 by 80, or we need to gross it up by 100 by 90? Yeah, you are right. We always need to gross it up 100 by 80, even if it is paid out of dividends income, savings income, or non-savings income. We always gross it up 100 by 80. Right? So discretionary trust is always 100 by 55, and interest in possession trust is paid 100 by 80, even if it is paid from whichever source, savings, dividends, or non-savings. Right? We'll see each and every bit. If you are confusing yourself here, you might start to think, I don't know what is all this about. If you're confusing yourself, you don't have to worry about it. We will look each and every component of income in turn, and we will see it in details, because each and every bit, almost each and every bit, has got a separate chapter on it, or even some cases a couple of chapters or more than that in it. Right? So these are the components, and this is how we write it down. If I just conclude by saying that trading income dividends income will go into the dividends 100 by 90 because 10% tax is paid on it. Interest income 100 by 80 because 20% tax is paid on it, and it will always go into the savings, and rest of the stuff will go into the non-savings. As far as discretionary trust is concerned, 45% of the tax is paid on it, so that's why 100 by 55, it will always go into the non-savings. Interest in possession, income from interest in possession trust, it will always go 100 by 80 because 20% tax is paid on it. and it depends how it is being paid off. If it is being paid out of non-savings income, we will write it here, and in other cases we will write savings or dividends if it is paid out of them. Right? Now there are quite other things as well to do, because I ain't got any space here, so that you will have to see from your notes, and I will see the notes on my own iPad, so that we will follow from here. Right? So we have done till, please keep your notes in front of you. I'm on page 2 here, where it says chapter 1, income tax. Now on top of that, if you see tax year, where it says income tax liability is calculated each year. Tax year runs from 6th of April till 5th of April, and for 15-16 it runs from 6th of April to 5th of April 2016, as I said there, right, because it is Finance Act 2015. Right? Now income tax format, which I have just made here, it is exactly like there. It is available to you there. So I will take each and every topic from there. So trading income, as I said, it will go into the non-savings. Pension income, it will go to the non-savings, as I've written here as well. What is the next one? Interest income. On your notes, please. Interest income 100 by 80, because 20% tax is paid here. If you look at the board, 20% tax is paid here. That's why we write it down as 100 by 80, and it will always go into the savings because it is interest income. Now the next one is dividends, 100 by 90, and it will go always into the dividends, right, like here, dividends, and it is 100 by 90 because 10% tax is paid on that. The income which I haven't listed here is other income. You might, if you want to write it down, if you're writing down on your notes, you should write it down somewhere if you want other income as well. Now other income could be earned from many ways. If I have extra car, I let it out to someone and I am earning some rent on it, then that is part of other income, and there could be many other sources as well. Right? So next one is property income, and other income will go also into the non-savings, as I said. Only dividends will go into the dividends, and interest will go into the savings, and rest of the stuff will go into the non-savings. Property income, it will go into the non-savings. Next is employment income. It will also go into the non-savings. Next one is income from discretionary trust. Like I've written here, income from discretionary trust. It is also, it will go into the non-savings, right? And the next one is income from interest in possession trust. It depends on which is it being paid off, and we will write it down likewise. So if it is being paid out of savings income, we will write it down in the savings, and if it is paid out of something else, then we'll write it down underneath that. Right? So likewise it is written here, but it will always be 100 by 80. Right? You have in the notes that if it is being paid out of non-savings income, it will go into the non-savings, and if it is being paid off something else, then it will go into the other sources. Right? Then after that it says less deductible interest. Now after you have done each and every bit underneath this one, we'll write it down, less deductible interest. Now what deductible interest is? It is a qualifying interest. We'll see later in the details, but for now you should just remind yourself, because there is a separate topic on that one, and there is a separate lecture as well. Right? Underneath that, if you see less deductible interest, it comes the net income. Net income before personal allowances. Now personal allowance at this level, if you don't know, you should go to F6 lecture where I have explained what the personal allowance is and all that. But for now, if you want just the overview of personal allowance, it is simply a threshold up to which you don't have to pay tax. So for current year, personal allowance is 10,600. So if you're earning up to £10,600 a year, you don't have to pay tax. So it is given to everyone. Even if you're earning £100,000, you have to deduct 10,600 because it is exemption. You don't have to pay tax up till that amount. So it will always be deducted. But we'll see later a little bit complications on that in the next lecture. Excuse me. Now, after less deductible interest, it comes at net income before personal allowance. After that, we'll deduct the personal allowance. Now, as far as personal allowance is concerned, As I said, it is 10,600. It is not written here because I've listed it down in somewhere else, because there is a separate lecture on that. Right, now if you look at the deductible interest again, please, I forgot something. Deductible interest, which is I will explain later, but for now, if you see into the sections non-savings, savings and dividends, it will always be deducted first from dividends, then from savings, and then from dividends. Right, it is written down there, first from non-savings, then from savings, and in the last it will be deducted from dividends. Then comes the net income, which is before personal allowance, and then the personal allowance will be deducted. Now, after deducting the personal allowance, I've listed down the tax table in the notes. If you see, after the deduction of personal allowance, the tax table is given. Now, this is just the tax table. There is no need to write down in the exam the tax table, because the tax table will always be given to you in the exam. So, if you see underneath personal allowance, that bit will be given to you in the exam. Whether examiner examines this question or not, it will always be given to you in the exam. So just to have an overview, if you see taxable income starting rate band. Now, income is always divided into the different bands. So say there are a few bands: the starting rate band, then comes the basic rate band, then higher rate band, and the last one is called additional rate band. So we'll see the bands now. The first band is called starting rate band. It is from £1 to £5,000. Say, for example, if you're earning up to £5,000, then this rate will apply. Now, what is the rate? If you're earning up to £5,000, then 20% into the non-savings, not percent into the savings, and 10% into the dividends. We'll see later in the details how does it work. But for now, if you're earning up to £5,000 and that income is, you are earning that income out of savings income, then you don't have to pay any tax, because it is not 0%. Now, if you're earning up to £5,000 and your income is out of non-savings income, then you will have to pay on 20%. And if you are earning out of dividends income and your income is under £5,000, then you will have to pay tax on at the rate of 10%. Then comes the basic rate band. Now, the basic rate band is obviously the starting rate band was from £1 to £5,000. So the next band is basic rate band. So it will be from the point where the last band is ended. So last band is ended at 5,000. So the next band will start from the £5,000 and 1. Right. So the basic rate band is from 5,001 to 31,785. Right. And the next band is higher rate band. It will also start from the point where the last band is ended. So the last band, which was basic rate band, is ended at 31,785, and the higher rate band will start from 31,786, and it will be up to the £150,000. Right. Now, at basic rate band and higher rate band, if you see, after the limits, I have written down in the brackets 26,785 and 118,250. Now, what is that? This is simply the difference between, if you look at the basic rate band, the difference between 31,785 and 5,001 equals 26,785, and difference between 150,000 and 31,785, difference between these two is 118,250. Right. So we will see in the later, when we deal with the questions, why we need it. You will know later. But for now, just to explain that this is the difference between them two figures. As far as basic rate band is concerned, 20% into the savings, 20% into the non-savings, and 10% into the dividends. Higher rate band, 40% into the savings and non-savings, and 32 and 50% into the dividends. An additional rate band, which is over £150,000. I think there is a mistake in the notes. I will update the latest notes later with the correction. But for now, if you in your notes, if there is a mistake, please make sure you mend this mistake, because rectify the mistake. It is from £150,000 and 1, right? So because the last band, which was higher rate band, is ending at 150,000. So the next band, additional rate band, will start from the next level, which is £150,001 and above that. So the next band will start from there, right? So that is the different. There are the different bands. Now, if after the bands, if you see, there are tax reducers, less tax reducers. Now, what are the tax reducers? Government encourages individuals to invest money into the different schemes. So when you invest some money into the different schemes, then you will have to pay less tax. The government gives some relief. So it is simply that. We will see later in the next lectures what are these. I will give you a lecture on each of the scheme separately, because there is a lecture and these are very important topics. But for now, these tax reducers are simply schemes where government encourage you to put some money to put your savings into that schemes, so that the government then in return gives you some relief. That's why these are given here. So if you put some money into the VCT, which is Venture Capital Trust, we will see later, but for now, if you put some money in VCT, you will get 30% relief. If you put some money in EIS, Enterprise Investment Scheme, you will get 30% relief. If you put some money into the SEIS, which is Seed Enterprise Investment Scheme, then you will get 50% tax reducer. So whatever amount you're putting, say for example, if I'm putting £100,000 into the Seed Enterprise Investment Scheme, so I will get 50% tax reducer. So how much amount did I put? £100,000. 50% of that is £50,000. So my tax will be reduced by £50,000. Say for example, if my tax liability tax was £100,000 and I got tax reducer of £50,000, so my tax will be £50,000. Right? We will see later in the details. You might be thinking, what this is, but we will see later. Now, underneath that, it comes the tax liability. So that is the tax liability which you have to pay. But you might have already paid some tax. We have to deduct that as well. So, say for example, here if you see on the board, dividends and interest income, discretionary trust, interest in possession trust, you have paid some tax at some point. So we will have to deduct that here. Right? So less tax deducted at source, right? So how much tax we have paid at each level. So tax liability, and after that less tax deducted at source. First of all, 10% of dividend income. So whatever the gross amount here is, here on the board, here if you look at the board, whatever the gross amount is here, we will take 10% of that and we will deduct it here, because that is a tax which we have already paid. Okay? Now 20% of interest income. Again, if you look at the board here, 20% of this figure we will put down underneath there, because this is the amount which we have already paid tax on. Okay. The next one is pay, P-A-Y, pay. Pay is the amount which is deducted by an employer. Say for example, if I am being paid a salary from AccountancyTube, when I check my payslip, the net gross amount is something else, but net amount which I am being paid, which comes into my bank account, is something else. It is a lot less than what the gross amount is. So the rest of the deductions are pay, P-A-Y. It could be something else as well, but pay is simply the amount which is paid on the salary, right? So because I have paid salary, so I will have to deduct that as well. Next one is 45% of gross income from discretionary trust. Now here, if you see discretionary trust, because 45% of the tax is being paid, so we'll have to take this figure here and we'll take 45% of that and we will deduct from underneath there, right? Next one is 20% from gross income, from 20% of gross income from from interest in possession trust. This one here, because we have paid 20% tax on that, and we will deduct this one as well, right? And we will deduct this one underneath there. And if you deduct all of these at end of that, if you come to the page 3 of the notes, on top of that it says income tax payable. So after deduction of all them deductions, the net figure will be income tax payable. Now it could be positive figure. If it is positive, then you have to pay tax. If it is negative figure, then the tax is recoverable or repayable. So if it is negative figure, that is the amount that you have to ask HMRC to pay you back, because you have overpaid some tax, right? So that is the net amount which is income tax payable or repayable. All right. So that was it, I think, and we've covered lots of stuff today. And in the next lecture, we will see some of these bits, because as I said, each and every bit of these has got separate lecture on these. So we'll see something from these, and we will see the personal allowance as well. As I said, that personal allowance is simply the amount up to which you don't have to pay tax, but there are some complications we will see later. But before we move to that point, let me see if I've covered each and everything. The one thing which I forgot was that if you look at end of the page 2, where it says tax liability, just before that there are a few tax reducers. Now if you look at the tax reducers, after that it says use following order. Now please make sure that you use this order, always use this order. So first of all, you will deduct income investment in VCT, venture capital trust, then you will deduct the EIS, and then you will deduct the SEIS. Please make sure you use this order, and after that it will come the tax liability. And after tax liability, if you see, there are tax deducted at source, right? Now when we are deducting them, tax deducted at source, always deduct the 10% of dividend income first. 10% dividend we deduct first because dividends are not repayable. So say for example, the net figure which comes in the negative, and some of that negative amount is being paid out of dividends income, then dividends are not repayable. That's why we deduct the dividends income first. If you're not understanding this point now, don't worry, we will see later when we do any question, then you will understand it better. But for now, please make sure that you use this order as far as tax reducers is concerned, and the tax deducted at source is concerned, right? So that's it for now, I think, and I will see you into the next lecture with personal allowances and some more bits and pieces out of these. Right? Till then, goodbye.